10-year note treasury yields nearing 1.5%. Recall just a short time ago we were talking about them just dipping below 160, and then here we are a few sessions later, boom, we're nearing the 150 level. So things have definitely picked up momentum as far as the trade. We had seen a move in yields higher. We got close to 190. Now we're seeing them back down to close to 150. And really within a stone's throw of that 142 low we put in last month. And at this point, I think it's probably going to happen sooner than later because the uncertainty we're seeing, the negative data we're receiving, the uncertainty from the Fed and likelihood that they're going to have to be cutting rates more aggressively than earlier expected, all points towards lower yields. And I think at this point, 142 is going to come very quickly. Obviously, we were trading much higher just recently, and that didn't seem like it was possible. But I think after this week's bout of data, with what we're seeing in the equity markets, what we're seeing overseas, the global growth story is starting to get some teeth here, and lower yields are likely coming and coming fast, despite the move we've seen over the last 6 sessions. And if you look at market volatility, as yields go down, market volatility had been going up at a pretty good rate. But today we saw a little bit of the opposite of that, and I think a lot of that was maybe some profit taking because there are buyers out there that need and have to buy, yet there are some longs out there that may be looking to get out and maybe reload at better levels or try something else or maybe in a different bucket. And at this point right now, volatility will continue to remain elevated, but it didn't go higher today, which was a little bit of a surprise. But again, some profit taking likely was the cause of volatility holding steady. And lastly, let's look at what we have ahead. Yeah, we've got some significant data, and on Friday we've got the payroll numbers. Obviously, that's going to be significant because, well, jobs have not been the problem from day one. Since the market had started to get its sea legs back under it from the financial crisis back in 08 and 09. But if we start to see some cracks in the dam, that will be significant because we're seeing manufacturing struggle, we're seeing other areas of the economy struggle. If jobs start to struggle too, then it becomes sort of an all-in global growth story. So at this point, jobs number needs to be at least at expectations, if not higher, for the market to remain sort of where we are right now, if not see things retrace what we did a little bit of this week. Secondly, we have Mr. Powell speaking. Obviously, I think he wants to talk down some of these expectations that are printing in Fed funds world. Yeah, last week we were looking at maybe 40% odds that the Fed would cut 25 basis points this month. Yeah, that's closer to 100 after this week's data. So right now, the market really leaning towards a 25 basis point cut with about a 60% chance that they go again in December. So more rate cuts are coming this year, and they're likely not the kind that the Fed says, boy, I think we should cut today. These are the kind they say, oh my gosh, we have to cut today, and that is likely going to be the story. But Mr. Powell comes out, maybe we'll try and calm the markets a little bit. I'm not sure even he can do that heading into a weekend. So at this point, 10-year note yields looking to make new lows for the year as we push towards that 142. Likewise, a more aggressive Fed coming with more rate cuts. Will there be QE behind it? Most likely. And if you look at volatility, it's elevated and was down today, but don't expect that to stay the same. I think we're going to see volatility go up higher as we start to enter new territory here, and the Fed really has to start acting instead of talking.